All right, welcome to this explainer on Progressive's latest financial numbers. Today, we're unpacking what I like to call a massive contradiction in the auto insurance giant's July 2026 report. You see, it's a completely fascinating scenario where the headline numbers are telling this really gloomy story, but the market's reaction? Well, it's telling an entirely different, highly lucrative one. To set the stage here, let's look at a headline that would normally send investors literally running for the hills. In July 2026, Progressive's net income dropped a really steep 12% year over year. That brought it down to $961 million. And earnings per share? They similarly took a hit, falling 11% to $1.65 from the previous year. So strictly on paper, it looks like a pretty rough month, right? Yet in response to these shrinking profits, the stock price actually jumped 4% on the exact day of the report, closing at $217.28. I mean, it is incredibly rare to see a stock just jump like that on exceptionally high trading volume right after a double-digit earnings miss. We're talking nearly 4.87 million shares changing hands. That's about 60% above their 90-day average. It was literally their strongest single-session move in recent memory. Okay, so we really need to dive into this. Why on earth did Wall Street actually cheer for lower profits? Like, why would investors aggressively buy into an insurance company that just reported a double-digit decline in earnings? To solve this mystery, we're going to have to peel back the layers of this financial report and see exactly what the smart money was looking at. To really understand this, we first have to look at how Progressive actually makes its cash. A massive 83.5% of their net written premiums comes directly from personal auto lines. Commercial auto and truck insurance make up about 12.8%, and property insurance rounds out the whole shebang at just 3.7%. Basically, if you drive a car and pay a monthly premium, you are the fuel for this massive engine. And that core engine? It is absolutely booming right now. Progressive hit a record, get this, 40.3 million total policies in force across all their lines. That is a seriously impressive 7% increase from last year. Direct auto policies were up 9%, and agency auto was up 7%. So fundamentally, their core business of getting people to sign up for insurance is absolutely thriving, at a time when a lot of their peers are really struggling to grow. Now, the paradox really starts to unravel when we separate their operational success from their investment portfolio. Total revenues reached $7.8 billion, an eye-popping 27.1% increase year over year, completely driven by that premium growth. But that bottom-line profit drop we talked about, well, it was largely driven by a one-off $47 million pre-tax realized loss on securities. Last year, they actually had a $79 million gain. So that's a massive $126 million swing that totally distorted the underlying picture. Basically, Wall Street completely ignored the investment noise and cheered for the massive operational win. To really grasp the scale of that operational win, we need to look at the holy grail of the insurance world. It's called the combined ratio. It's simply the percentage of premiums paid out as claims and expenses. The golden rule here? Anything under 100% means the company is profitably writing policies before they even touch their investment portfolio. Progressive's combined ratio ticked up just a tiny bit to 86.8% from 85.3% a year ago. Yes, it deteriorated slightly because of higher claims costs and underwriting expenses. But an 86.8% ratio means they are keeping roughly 13 cents of pure underwriting profit for every single dollar they take in. That is well below the company's 96% target. And honestly, it remains absolutely enviable by standard industry metrics. Wall Street's divided house. Let's see why the market is so incredibly split on what this all means. Over the past year, Progressive shares actually lost 14% against the broader insurance industry's growth of 2.7%, and that's led to some genuine uncertainty in the market. Out of 25 analysts polled, the consensus rating is just a hold. On one side, you've got bulls like Bank of America projecting $309 a share, which implies nearly a 41% upside. But on the other end, bears like Wells Fargo are maintaining a sell rating with a target of $201, while Cantor Fitzgerald is just sitting completely neutral at $200. So what exactly is driving this massive divide? Well, the bulls are basically popping champagne over this robust policy growth. I mean, Progressive added 150,000 new auto policies in July alone, which more than tripled what they added in June. Plus, they see a really big capital deployment opportunity. But the bears, they are sweating over margin compression and a valuation that leaves absolutely zero room for error. The stock currently trades at about a 10.8 times price-to-earnings multiple. That's right around the industry average for sure, but it is notably higher than their peer average of just 8.3 times. Following the smart money. Let's take a look at what the big institutional investors are doing. The big money is heavily invested here. Institutions own a commanding 85.34% of the entire company, and they've been busy. Heavy hitters like Bank of New York Mellon recently purchased over 3 million shares in the second quarter. That's a stake valued at roughly $659 million. We also saw Norges Bank buy a massive new $1.84 billion stake, and Allstate more than doubled its position. The institutional conviction, yeah, it is clearly present. But on the flip side, we do have to look at the insiders. CEO Susan Patricia Griffith recently sold over 37,000 shares for a total value of about $7.94 million. The new Chief Personal Lines Officer also sold shares recently, which brings total insider sales over the last 90 days to $17.4 million. Now, it's super important to remember that these sales are very often part of prearranged trading plans for, basic portfolio diversification. So it's not necessarily a massive red flag, but it is definitely a data point you have to factor into the complete picture. To give you a completely impartial view of the road ahead, we really need to cover the key headwinds facing the company. First up is margin pressure from persistent inflation in auto repairs, labor, and healthcare. Second, they are really struggling with their Robinson strategy. In the insurance world, Robinsons is this industry nickname for highly coveted customers who bundle their home and auto insurance together. Progressive is struggling to scale this lucrative demographic, with property policies remaining totally flat year over year at 3.6 million. Add in that elevated valuation we talked about, heavy competition now that they've actually overtaken State Farm as the largest private passenger auto insurer, and the clear volatility of their investment portfolio, and well, the risks become pretty apparent. So, what does this all mean? The crucial point leaving you to weigh the evidence is simply this. Can Progressive stabilize its combined ratio and finally scale those highly profitable bundled Robinson customers to justify its current market valuation? Or will rising industry costs and persistent inflation hit the brakes on their really impressive top-line momentum? It's a massive profit paradox. How Progressive navigates these next few quarters won't just determine their stock price. It will absolutely determine which side of Wall Street was right all along.